When many people start investing in Canada, they quickly discover that the financial market offers thousands of different investment options. There are individual company stocks, actively managed mutual funds, bonds, real estate funds, and many other financial products. For beginners, this large number of choices can make investing feel complicated or even intimidating. Many new investors worry about making the wrong decision, losing money, or choosing the wrong company to invest in. However, there is a simpler strategy that many experienced investors use. Instead of trying to pick individual winning companies, they invest in diversified funds that represent large portions of the global economy. One of the most popular tools for this strategy is something called an ETF, or exchange-traded funds. An ETF, or exchange-traded fund, is a type of investment fund that contains many different assets inside a single investment. Think of it as a basket that holds many companies together. Instead of purchasing shares in just one company, investors who buy an ETF are effectively investing in a large collection of companies at the same time. For example, some ETFs hold hundreds or even thousands of companies from different industries and countries. This structure allows investors to participate in the growth of entire markets rather than relying on the success of a single business. For beginners especially, ETFs provide a simple way to start investing while reducing the risks associated with individual stock selection. One of the most important concepts in investing is diversification. Diversification means spreading your investments across many different assets instead of concentrating everything in one place. The reason this matters is because individual companies can experience unpredictable outcomes. Even large and well-known companies sometimes face financial difficulties, industry changes, or unexpected economic challenges. If an investor places all their money into a single company and that company performs poorly, the impact on the portfolio can be severe. However, when investments are diversified across hundreds or thousands of companies, the risk associated with any one company becomes much smaller. ETFs are designed specifically to provide this type of diversification, which is why they are widely used by beginner investors. In Canada, several ETFs are widely recommended for beginner investors because they offer broad diversification and simple portfolio management. For example, VECT and XEQT are all equity ETFs. These funds hold thousands of companies from markets around the world, including Canada, the United States, Europe, and emerging markets. Because they focus entirely on stocks, they aim for long-term growth but may experience more short-term volatility. Another popular ETF is VGRO, which includes a mix of stocks and bonds. This combination reduces overall volatility while still allowing investors to participate in market growth. These types of ETFs are often called all-in-one ETFs because they already contain diversified portfolios within a single investment. Many experienced investors follow a long-term investment strategy rather than attempting to predict short-term market movements. Instead of frequently buying and selling assets, they invest consistently over many years and allow their portfolios to grow gradually. This strategy works because financial markets historically trend upward over long periods of time as economies expand, companies grow, and productivity increases. By investing regularly and holding diversified ETFs, investors can participate in this long-term growth without needing to constantly monitor individual stocks. To understand how powerful long-term investing can be, consider a simple example. Imagine an investor contributing $1,000 each month into a diversified ETF portfolio. If that portfolio earns an average return of approximately 7% annually, which is consistent with historical long-term market averages, the investment could grow to over $170,000 in 10 years. Over 20 years, the same investment could exceed $500,000. This example demonstrates how consistent contributions combined with compound growth can create significant wealth over time. Another advantage of ETFs is that they often have very low management fees compared to traditional mutual funds. These fees are commonly referred to as the management expense ratio, or MER. Even small differences in fees can have a large impact on long-term investment returns. For example, an ETF with a management fee of 0.20% will allow investors to keep much more of their returns compared to a mutual fund with a fee of 2%. Over decades, these differences can amount to tens of thousands of dollars. For many beginner investors, a simple strategy can be surprisingly effective. Instead of constantly searching for new investment opportunities, they select one or two diversified ETFs and contribute regularly over time. By automating monthly investments and maintaining discipline during both market growth and market downturns, investors allow their portfolios to grow gradually without unnecessary complexity. It is important to understand that financial markets do not grow in a perfectly straight line. There will always be periods of volatility when prices move up and down. Economic events, interest rate changes, and global news can all influence market movements. However, long-term investors recognize that these fluctuations are a normal part of the investing process. Rather than reacting emotionally to short-term changes, they remain focused on long-term financial goals. For beginner investors in Canada, ETFs provide a powerful combination of simplicity, diversification, and low cost. By investing consistently in diversified funds and maintaining a long-term perspective, individuals can participate in global economic growth while managing risk effectively. For many people building their financial future in Canada, ETF investing becomes the foundation of long-term wealth creation.